Hey there, guys. Welcome to another episode of Real Estate Steals, Deals, and Opportunities. Today, we're going to talk about a subject called hard money. Some of you might know it as private equity funding or hard money loans. All right, let's get my... Okay, here we go. All right, so how do investors get the money to buy investment property quickly? How do we go from being a ready and willing buyer to being a ready, willing, and able buyer? So cash is what makes us able, right? The ability to get the funding if we don't already have the capital to purchase a property. Otherwise, we're competing against cash buyers or so-called cash buyers that can close quickly without a million contingencies, including financing contingencies. So if we're trying to get in that same game and we do not have access to the same money as our competition, and we need 30, 45 days for traditional financing, and we need a contingency on financing, we're never going to be able to compete in the same way to get the same properties as our competition. So today I want to explain hard money to you, where you can find it and how it works. All right, so I'm going to compare the difference between traditional financing and non-traditional financing. So non-traditional financing would be where we find the loans that don't have to comply with Fannie Mae guidelines. These loans aren't necessarily being sold on another market. There might be portfolio lenders or hard money lenders, private guys who are licensed as lenders but lending their own money. And so they can create the rules and the criteria and lend it out as they choose. So traditional financing is the type we call conventional financing, so to speak. You can go into any bank and apply for a loan to buy a home there. And typically that would be traditional financing unless you're going in under one of their non-traditional financing programs, okay? But there is a big difference. So traditional financing has a lot more hurdles for you to jump through in order to get the money than non-traditional financing. A lot of people say, oh, hard money is called hard money because it's so expensive and it's unaffordable and it takes all the equity out of your deal. Well, this is not the case. If you actually take a deal that you're looking at and you compare traditional financing costs to non-traditional financing costs, or let's say a hard money lender, hard money loan, and we do a lot of those here, you will find that it's actually less expensive to go with a hard money lender. There's less capital needed out of your pocket, and you will get that home closed quicker. So if it's a cost of doing business, then you're going to add this to your budget. You're going to include it. If you've gone through the webinars with us on how to do your formula, if you have financing included because you don't have your own cash, so you have the cost of financing included, you will simply incorporate that into the budget of the money necessary it takes to do your deal, and then you will buy a deal accordingly. But now you'll be able to compete with the other cash buyers because you've got same as cash when it's hard money financing, okay? So as far as the down payment goes, traditional lenders on an investment property will want anywhere from 20 to 30% down, maybe even more. So this is how much down payment you will absolutely have to have based on either your purchase price or the appraised value, whichever is less, okay? Typically, hard money lenders want to see 10% down, or they might even lend at 100% of your purchase price, depending on what you are paying for the property and its after repaired value. So they're typically looking at being in a safe loan position of 65% loan to value, but they're not requiring as much of a down payment depending on what you're paying for the property. So it's a little bit different in your out-of-pocket money there. Okay, traditional financing typically needs 30 days to close, okay? And typically we're finding that they want more and more time. So 30 days isn't even enough. And now you've spent all this money and time, 30 days, and then your seller won't give you an extension because he's got backup cash buyers ready to close the next day. So you're just not in a position to compete. You have no leverage unless nobody else wants that property. All right, so a non-traditional lender can close in as little as 5 to 10 days. We've got lenders that can close in 24 to 48 hours. It just is a matter of, is the title work done and is the lien search done? So non-traditional financing closes much faster because they have much less criteria that they're looking at in most cases. Traditional financing involves qualifying the borrower more than qualifying the property. Non-traditional financing is looking at qualifying the property more than the borrower. So they're looking more at the property. Hey, if you fail in your loan and we take this property back, what can we sell it for and how fast can we sell it? How can we liquidate this asset we don't want and get our money back? And so they're looking more at the property and not as much as the borrower. That's why credit isn't as important in these non-traditional financing arenas, okay? So appraisal is needed in traditional financing. You have to get an appraisal on the property. It may or may not be required for a non-traditional lender. It's really up to them. You know, each lender is different, just like each investor is different and their own criteria is different, okay? In traditional financing, repair funds that you are that you are going to spend on the home, you must be able to show that you have repair money in escrow to fix up that home. Okay, that's traditional financing. Now, there are loans out there that, you know, they'll lend you the repair money too, but you've got to jump through so many hurdles and get so many estimates, and you need so many more days to close and all of this. So like I said, it's just not the same as these non-traditional guys that, you know, this is their business. You know, their business is investment property and investment loans. And so they know what they're looking at. And so with them, they will actually give you the money to fix up the property. They will put it in escrow. And as you fix it up, you can pull out draws to reimburse yourself. Okay. Principal and interest payments are made in traditional financing. However, we all know it'll take years before we're even paying, you know, a decent portion towards the principal. So it's kind of irrelevant. And in non-traditional financing, and the reason it's irrelevant is because, you know, typically these are short-term, get in, fix it up, and get it out properties, right? Now, if this is a long-term add it to my rental portfolio decision, well, then that might be a different decision for you. You might say, well, traditional financing will work for me. Okay, but in the case for flippers, non-traditional financing seems to majorly outweigh the benefits of traditional financing. And so with non-traditional financing, typically the interest rate is interest only. It is a higher interest rate because they're taking more of a risk. They're not going through all these hurdles to qualify you. Most of their borrowers are self-employed. They are investors. This is what they do. They don't have tax returns and all of these things. That's why it's based on the home and not on the borrower, because that's who they're lending to as flippers. All right. So the interest payment or the mortgage payment will be interest only for the short term that you have the property. In traditional financing, you might be able to get a short-term loan. However, they will charge you prepayment penalties if they can. And if they can't, you're going to pay points in order to get the loan at a decent interest rate. Otherwise, you're going to pay pretty much a higher interest rate, but you might beat a hard money lender's interest rate by a few points. Again, you've got to weigh the costs and say, yeah, but at least with the hard money I'm getting in right now. And, you know, it really does work out to be better for me. So non-traditional finance is typically short-term. They are in it for you to get it fixed and flipped, or you get it fixed and then ultimately refinance it. In any event, you're either refinancing that property, paying it off, or selling it in some form or fashion before the maturity date of that loan, okay? So with traditional financing, they may allow you to go ahead and move into the property. You might not be exempt from moving into the property based on the type of loan that you got, but it's still traditional financing with a lot of costs and time incurred. With non-traditional lenders, hard money lenders, the majority of them will not allow you to move into the property. These are not owner-occupant loans. These are loans for investors, and they are lending to you as an investor, and that's why this works for them. If they are lending to owner occupants, that is a completely different story that many times exempts them from lending in their capacity. All right. Traditional financing, these loans do report to the credit bureau. So if you missed a payment or anything negative happened along the way, it would report on your credit report. With hard money financing, the majority of these lenders do not report to the credit bureau. And for many investors, they really believe that that is a plus. So there are many pros and cons to both. And these are simply the bullet points that I'm reviewing with you today, because many of you that are looking into investing have heard of this hard money and have thought, well, that's insane. Why would I pay 12% interest and 3 points when I can go to the bank and get 4%? Well, what I tell you is go do it. Go to the bank and go ahead and get pre-qualified for an investment purchase, and then begin making offers on properties where you are coming in as a financed buyer, and see how many properties you get to buy. In a hot market, you're not even going to be able to compete. So if you want to get in the game, you've got to get in the game with the kind of money that's going to help you get in the game. And not only that, guys, when you're a newer investor, a lot of newer investors I notice need capital. They do need the hard money lenders to come in and equip them and help them. They don't have a full-time job, so forget it. They're not even going to be able to get a traditional loan in the first place because they're not showing income. And so non-traditional lenders, they don't care. They're, like I said, they're looking at the property. So if a newer investor can get into a flip property with a hard money lender, well, that's going to enable them to get started in the business. The other benefit is that these hard money lenders know what they're looking at. So many times they come in and they'll say, hey, listen, you're paying too much. I'll lend you this, but you need to be paying this. Go back and try and renegotiate. Here's what you should pay. And they give you the advice that you need to hear. And so a lot of times someone with limited capital gets that extra advice just as a bonus. They think they're, hey, I don't have enough money. This is really a deterrent for me. But in the same time, because they don't have enough money, those lenders are giving them some well-deserved and needed advice to help protect them in their deals. And so a lot of people with capital will go out without a lot of education and without getting the appraisals or inspections or everything they need, and they will jump into their first flip property and be lucky if they make a profit because they didn't really have enough advice. They thought, I have all the resources, I'm just going to take a gamble at it and hope I know enough. So, it can be a plus that you actually go to these guys and get their advice and get their money. All right, so we're going to wrap it up with a simple formula that shows you how to calculate the cost of a hard money loan based on interest and points alone, okay? So in this scenario, our interest rate for this hard money loan is 12% interest only and 3 points. Now both the interest and the points are based on the loan amount, not on what you're paying, all right? So let's assume that you're buying a property that's worth $200,000. You're buying it for $130,000, which is 65% of that 200. And so based on $130,000, 3 points, which is 3% on the loan amount, would equal $3,900. All right, then we're going to take $130,000 and we're going to multiply it times 12%, which is our annual interest rate. That would give us $15,600 for a full year's interest payments. We're going to divide that by 12, and our simple monthly mortgage payment at 12% interest only on $130,000 is $1,300. Okay, so now we know the cost of our money is $3,900, boom, right up front, and $1,300 a month interest only. So if we own this home for 6 months, if we're calculating in our formula that we're going to have this home for 6 months, then it would cost us $11,700 for the cost of that money. So as you can see, once you have your own capital to work with or a line of credit at a far less expensive interest rate, you're going to be able to buy more property or pay more for the property because your cost of money will be far less. But in the beginning, if this is what you have to work with, then you're going to be including about $12,000 in this scenario on your budget that you're going to be able to offer about $12,000 less than someone who's offering cash. And so that would be your drawback. However, you're still able to offer and close quickly. So it still puts you in the game. So you may be able to borrow more for renovation. Sometimes it looks like this, like you're borrowing the $130,000 to buy it, but the lender's going to put another $25,000 into escrow and give you draws as you fix up the house, or wait till it's completely fixed up and then release that $25,000. So in that case, your loan amount would be $155,000, right? So your loan amount would be based on $155,000, even though $25,000 is being held back. Your interest and your mortgage, your points would be based on 155, and your monthly mortgage payment would be based on the 155. So it would change this by increasing it a little bit, but now you would actually be enabled to do the renovation because you're being loaned the money to do so. So you see how it can enable you. These lenders, because it's their own money for many of them, they can be very creative and, help you structure a loan that allows you to get in the game. And so that's what I wanted to share with many of you today that want to invest in real estate, but you think that you're unable to because you don't quite have all of the money yet, but you may have some. So you do have to have some money. Hard money lenders will not give you 100% of everything, especially when you're brand new, because you are a risk. And so they're willing to put the risk into the value of the home, but not into you necessarily, okay? So if you want to reach me, I'm here in South Florida. You can learn more about hard money lending through us at 32wesrealty.com/hardmoneyfunding. You can email me or call me at these numbers. We are in South Florida, and we cater to real estate investors looking to purchase properties in our backyard. And if you enjoyed what you learned about hard money, and I hope you did, then learn more about real estate investing and other amazing topics online via live interactive video conference classes at learnfromgreen.com. When you increase your knowledge, you increase your income. Thanks for tuning in today, guys.